In 1929, the U.S. stock market collapsed, triggering the Great Depression. Stocks fell 89% over 3 years. Unemployment reached 25%. Banks failed. Personal savings were wiped out. It took 25 years for the market to recover. In 2008, the housing bubble burst, starting the Great Recession. Stocks dropped 57% in just 18 months. Unemployment rose to 10%. Banks required massive bailouts. Retirement accounts were devastated. Recovery took 5 years. But 2025 is different. This time, stocks, bonds, and real estate are all crashing simultaneously. Financial historians call it the everything bubble because there is literally nowhere to hide. We are not in a new situation. We are at a point similar to 1928, just before the Great Depression. Except this time, the tools that saved the economy in 1929 and 2008 no longer exist. The Federal Reserve cannot cut interest rates to zero. They are already historically low. They cannot print unlimited money. They just did that and triggered the worst inflation in 40 years. The government cannot bail everyone out. It's already drowning in $36 trillion of debt. Let's examine why the coming crash is unlike any previous financial crisis and why November 2025 through June 2026 could be catastrophic. The stock market bubble. The S&P 500 is trading at a price-to-earnings ratio of 28, nearly double the historical average of 15 to 17. This extreme valuation has occurred only twice before, in 1929 and 2000. Both times, the markets crashed within months. Concentration risk makes 2025 even more dangerous. 7 stocks, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, account for nearly 30% of the S&P 500's total market value. If these stocks fall, the entire market follows. Take Nvidia. It trades at a price-to-earnings ratio above 65, meaning investors pay $65 for every $1 of profit. Its market cap exceeds $3 trillion, more than the entire German stock market, the 4th largest economy in the world. This is speculation fueled by AI hype, much like the dot-com mania of 1999. The real estate bubble. Residential real estate is more overvalued than in 2008. As of November 2025, home prices are approximately 50% above long-term trends relative to income and rent. In 2008, homes were only 35% above trend. Commercial real estate is in free fall. Office vacancy rates across the U.S. are around 45%, with cities like San Francisco at 35%. Mortgages taken out at 3% now must be refinanced at 7 to 9%, making default inevitable. This will trigger bank losses and cascading failures, similar to 2008, but focused on commercial properties.
The bond market bubble. Government bonds, traditionally a safe haven, are no longer safe. Federal debt exceeds $36 trillion, about 125% of GDP, comparable to post-World War II levels. Annual interest payments now surpass $1.2 trillion, more than defense or Social Security spending. When interest costs dominate the budget, the government has 3 choices: cut spending drastically, raising taxes significantly, or print money. All 3 options lead to economic crisis. The everything bubble. Stocks are overvalued at levels seen only twice before. Real estate is more inflated than 2008. Bonds are collapsing under unsustainable debt. The S&P 500 PE of 28 mirrors extreme valuations in 1929. Then it was electricity, cars, and radio. Now it's AI. Leverage is everywhere. Margin debt, corporate buybacks, options trading, derivatives. Wealth inequality is at historic highs. The top 1% owns 32% of total wealth. The top 10% controls 70% of consumer spending. Why 2025 is worse than 1929 or 2008? In 1929, only 10% of Americans owned stocks. Today, 58% of U.S. households invest in stocks or retirement accounts. Losses hit everyone immediately. Banks are fragile. The FDIC has $125 billion to insure deposits totaling $10 trillion. Multiple large bank failures would require trillions, destroying the currency. The Fed has lost credibility. Tools that worked in 2008, interest rate cuts and quantitative easing, are exhausted. Government bailouts are impossible at this scale. Consumer, corporate, and global risks. Credit card debt exceeds $1.14 trillion, with delinquency rates rising. Auto loan defaults are at 2008 levels. Average monthly payments exceed $740 with 84-month terms. Student debt totals $1.77 trillion, with widespread defaults. Corporate debt has quintupled since 2008, now over $10 trillion. Geopolitical risks, Ukraine, Middle East, Taiwan, energy crises make international coordination unlikely. No major economy is positioned to lead a recovery. The cascade effect. The crash won't begin with a clear signal. It could start with a tech earnings miss, a regional bank failing, or rising geopolitical tensions. Automated selling, margin calls, and institutional risk management will trigger a domino effect. Within weeks, the market could drop 30 to 40%, followed by bonds and real estate, rising unemployment, and widespread defaults. Recovery prospects. In 2008, recovery took 5 years. Japan's 1990 crash took 34 years. 2025-2026 could rival or surpass that. Retirement accounts may drop 60 to 70%. Homeowners could become underwater. Entry-level jobs for graduates may vanish. Small businesses could fail by the hundreds of thousands. Social safety nets will be strained beyond capacity. This is not speculation, it's pattern recognition. The same signals that preceded 1929 and 2008 are flashing. Only this time, everything is aligned for maximum destruction. Conclusion. The everything bubble leaves no safe zones. Stocks, real estate, and bonds are vulnerable. Consumer debt is at record levels. Corporate leverage is extreme. Government resources are tapped out. The crash is coming. The only question is how prepared you are when it hits. 2025-2026 will change everything.